Hey traders, Stephen Kowitzel here with TradersPlan.com. It's Thursday, September 6th. Wow, it's just getting into the latter part of the year for sure. We're going to look at the individual indices. We're going to look at some sector charts and some industry charts and just kind of see what's really going on. The market started to pull back, or at least the tech stocks have the last couple of days. So is it an opportunity? We'll just kind of take a look at that. Let's start with the NASDAQ composite. So there's a couple places it's sitting on. First, I want to add it's really been rallying. You can see this is a strong rally and it found support at the 20-day moving average. But I'd say this rally has clearly found the red line, found support more times at the 50-day moving average. You can see 1, 2, 3 times. Now, the fourth time it's getting a little long in the tooth. I would actually argue that the third test of any support level is getting long in the tooth as it's headed the way up. But you want to look for bullish signs, not bearish. You can see right here that the NASDAQ clearly broke out, had this reversal day. I think it was last Friday. Started to come down, and then the last couple of days we've seen some distribution, and I'm sure this day will probably be a good above average volume day as well. So really, we'll chalk it up to 4 out of the last 5 days, including this day. There have been a distribution. Now, this has happened before, and it just kind of took a couple days and came right back up. So it is sitting at a horizontal support, and even though it broke through the 20-day moving average, sitting at a horizontal support, and it's sitting at the trend line support. Because you can see this trend line goes all the way back to April, has been touched many times, along with the 50-day moving average. So I wouldn't say that the trend line is, is the end all be all. Probably more in this 7,800 to 7,900 zone. I would look, and if it holds that, that'd be the first test. If it holds 78, 7,900, probably a good opportunity. But if it starts to break, then I think we're clearly looking at something a little deeper than, 3% pullback. So I would not get too concerned, although we're going to look at some of the growth stocks are getting hit. I wouldn't be too concerned about this until the 7,800 level starts to crack and then it starts to come under it. There's a big divergence between international emerging markets and the U.S. stocks, so we'll look at that more. But right now, I'd say it probably could pull back another day. We'll kind of wait and see what it does on Friday. September is not a historically great month, but in technical analysis, that really means nothing, right? It just kind of gives you an idea of what's possible, but you always have to follow the price action. So if we look at these pullbacks right here, they all looked ugly. This looked ugly right here. You got a nasty reversal, another down day, big gap down, another down day, and then it firmed up right at the 50-day moving average. Same thing here. You had a reversal, but it came back, took that out, and got slammed back down, and then found support. And this was a lot neater. You can see there's a big difference between this pullback, and this pullback. But this one's looking like these two, so we'll just kind of wait and see. Again, you kind of got to take it day by day. The way I look at it is I don't necessarily, unless you're trading the individual indices, maybe leveraged ETFs, I don't look at it as, hey, you have to buy this pullback. I look at the individual stocks. Are the individual stocks setting up as the market is pulling back, or are they pulling back to support, or are they looking a little bit uglier? So I always try to focus on the growth stocks. What are they doing? And trade accordingly, because sometimes they're not always in line with the indices. The S&P 500 has really been grinding higher in this range, and last week it clearly just blew off the top. I was talking about this. The market sometimes can just, when it breaks to an all-time high, it'll just kind of blow off the top, suck everybody in. Anyone who's your traditional breakout buyer is in. Smart money is exchanging hands with the weak money. That would be you and me, or the weak hands, and unless you're an institution. And then they sell, and then that's when it pulls back. So kind of shake people out, and then they might accumulate here. But we really it's been grinding so higher. We haven't even had a pullback to this downtrend line. So even if it came down to here, that would not be a horrible thing or even a scary thing. Might be scary while it's happening, but it wouldn't be the end of the world because there's still a nice uptrend. The 200-day moving average is rising, but a lot of times when you get that upper channel and then it just clearly breaks, that's not the best time to buy. Sometimes it's the best time to raise your stops or maybe take some profit off the table in your short-term investments. So right now, we'll just kind of wait and see. It's still, the S&P 500 is still above the 20-day moving average where the NASDAQ is slicing below it. So tech stocks have been coming under some pressure. So again, just kind of wait and see. I'm always a fan of, you always want to pay attention to what the market's doing, but just more importantly, you want to pay attention to what your individual stocks are doing. If your individual stocks are hanging in there, typically when the market pulls back, you're going to find out which ones are your strong ones and which ones are a little sloppy and maybe you should lighten up on. If the market's pulling back and you're just getting slammed, sometimes that tells you what you need to know as far as on your positions. If you have some stronger positions and they might be pulling back, but they're not just heavy distribution, that means that it's really the weak hands selling, not the strong ones. So just really keep that in mind. When you start to get these distributions where they sell off, you really want to pay attention to what happens in the final hour. Like, is there some support coming in? Because sometimes I can tell you how bad it is. Like, if there's just not a bid in sight and it just keeps going down all the way into the close, that's never positive. But, if it sells off kind of midday, it kind of finds a bottom and comes back, that's what you want to see. We'll just kind of continue to have to watch this. Utilities are leading. And they have been leading this week. You can see utilities are up the most. Energy and technology is down. But that's just one day. One day is not a trend. And the last 1 week, utilities and consumer staples, the more defensive stocks are up the most. And that makes sense because I just showed you a chart where there's been distribution 4 out of the last 5 days. So again, sometimes when you start to see that distribution come in, you might want to keep your powder dry a little bit, or at least, be selective with your setups. Don't just trade just to trade. There is a time where it's time to just kind of sit back and watch a little bit. So we'll just keep our eye on this. But if we go, so we know in the last week, utilities and consumer staples, the more defensive stocks have been leading. Not a big deal. Let's go back in the last month. Now, this is when I start to pay attention. Utilities are still a leading industry group, and a part of that probably also has to do with the interest rates and how they are going. But it's still clear to me that I think that as far as aggressive goes, a lot of biotechs, a lot of healthcare is looking very bullish. I'm noticing a lot of bullish IPOs in biotechs. Now, these are not companies that are just making money hands over fists. A lot of times they're just trial-based type companies. But there's some really bullish setups in some smaller cap biotech stocks right now. But we're just going to continue to keep our eye on it, focus on what's strong. I always love, what I call going fishing. You go fishing when the market's really pulling back. You really want to find out what is holding up, what is hanging in there, what relative strength line is rising when the market's pulling back, because typically those are the biggest winners. Now we're in a 3-4 day pullback, so I'd hardly call this anything to worry about, just a normal reaction. But again, we'll have to keep our eye on it. So the S&P, let's go look at something for a second. I want to let's look at a perf chart of the S&P 500, the international stocks, VEU. Let's just go emerging markets and commodities. Let's just kind of stack all of these against each other. I'll go RJI. Let's just look at year to date. I think I did this earlier. 172, December 29th. That's close enough. Okay. So, for the most part, let's just say that the S&P 500, actually, let me go 171, is up about 7% from the start. So it's really interesting sometimes how a lot of these relationships start to decouple. And you have the red line is the S&P 500, clearly the winner. And it's interesting to watch how commodities were the winner. They were up here, and then they just really started to pull back, and U.S. stocks took the leadership. And then the blue line, you have international stocks, non-U.S., and then you have emerging markets. So when a lot of times you see this weakness right? You have a balanced portfolio of international stocks, U.S. stocks, commodities, all this stuff. It's really important. I look at the look back period of about 12 months if you're looking for some kind of momentum strategy. To really pay attention to, because a lot of times these relationships can go on like multi-year moves, where the S&P 500 might smoke international stocks, emerging markets, commodities, and then it's the other way around. So I think, 6-12 month look back period, something like that. But if you were to hold a balanced portfolio of all these things, I mean, you're probably down, because you have one that's 7%, one that's 0, one that's down 7, and then one that's down 12. So you would definitely be down. So a balanced portfolio, equal weight. Now, you're not going to equal weight all these. At least I wouldn't when I was a financial advisor. But my point is, sometimes momentum, it pays attention to know what is really showing momentum strength. And you want to make sure you don't want to have a bunch of laggards in your portfolio because they can really drag down performance, right? Just me, for example, use a simple momentum strategy for some long-term stuff. I don't have any of this other stuff down here because it's clearly lagging performance year to date or in the last 12 months. Now, if we go back 12 months, look at the difference. The S&P 500 is up 17% and emerging markets is down 5%. So you have all this underperformance dragging you down. And yes, there will be times where it will flip, but I really think and a lot of this happened. You can see a lot of them moved together, and then right around here, the dollar started weakening, and then the other three went the other way, and then the S&P 500 was positive. But it's just really important to pay attention to what's weakening. But just as important, when you see all of these emerging markets and international stocks down, mostly a lot can have to do with the dollar, but they're usually global markets. They do move together. So are these going to drag the U.S. market down, or is the U.S. market going to bring these up? Something has to happen eventually. I would be really surprised if the U.S. just continued to blow everything out of the water when everything else is going down, because these charts don't look good. The CRB just had a death cross. The 10-week went under the 40 weeks. So it is just worth noting in some of these trends that have to do with the dollar, that can be in multi-year bull markets, that have to do with commodities that can be in multi-year bull or bear markets, to make sure that you're just not overweighting the weaker ones, so to speak. So I just kind of wanted to show you that real quick. Let's go back and give me just a second. Let's look at the TLT. So I think it was probably 2 weeks ago when I last shot one of these market update webinars, because last one I did the my worst trades of the year. So you had this breakout of TLT bonds, and that means that the yields are struggling a little bit. And I said right here, this is not necessarily a definitive breakout. I think it needs to clear this horizontal pivot and just clearly break out to signal a trend change. Well, it's pulling back under. So is it going to just make another higher high, or is it going to just going to continue to come down here? I don't know right now, but I can tell you right now that get those notifications off. I can tell you right that this failed, but is it just going to come back, shake everybody out, and go the other way? I don't know. I think it really is important to look at yields right now. Let's look at the 10-year Treasury yield, and you can see that it's really just basing. Let's kind of go out just a little bit more. So you have the 10-year Treasury yield. It's got an inverse relationship with bonds. So it made a major move, kind of made a bull flag, broke out, and then is just really in this big trading range, right, between 3.1 and 2.8. So the question is, which way is it going to go? It's best to not to just try to predict too much. It clearly has some horizontal support until it really breaks one way or the other, but I'm not going to pick which way it's going to go. Sometimes I always look at the other to see if one looks more bullish or one looks more bearish. It would be really interesting if yields did just absolutely fall off a map right here, just given the fact that we're raising rates. But I think long term they'll go up. But bonds are trying to break out. We know that, and yields are just clearly basing and have been basing all year. So it's a development that will affect a lot of things. as far as utilities and other things like that. So we'll just have to keep our eye on that, because obviously if we go back to, let me kind of get back to that TLT chart, you can see that the TLT is, for the most part, highly correlated with utilities. Meaning if bonds go up, that means utilities are going to go up, REITs are going to go up, telecom will help because their interests, they have dividend paying stocks. So it could really, really help to pay attention to which way these are going to go, because you might want to overweight. If bonds are going to break out, then you probably want to overweight conservative, high-yielding stuff, because that's going to have a positive correlation on utilities and REITs, which are looking pretty bullish right now, and they continue to look bullish and grind their way higher. Now, I find it hard to get excited about REITs and utilities, but they can make runs, and they can make big runs. So we'll just kind of keep our eye on everything. Let's look at the dollar. Oh, excuse me. Let's just kind of go down here. So you have the USD, the weekly chart, and we know it broke out of Head and Shoulders. We know it broke out as downtrend. The trend has reversed. It popped real quick, so that was a definitive breakout. I mean, it was crystal clear. And now it's pulling back into this zone. It deserves a breather, so it might go sideways for a little bit, and we'll continue to keep our eye on it. But it's clear when you look at these relative charts, because they're all related, how much the S&P is outperforming emerging markets and international stocks. But it's interesting because the small caps are starting to underperform the S&P 500, which makes sense because the dollar has pulled back a little bit back to this support zone. So nothing really too exciting. I'd say it's just pulling back to support right now. And if this obviously does roll over, all these could change, right? Everything would make sense, and then you probably want to look to overweight international stocks, but typically that doesn't happen immediately. Like, you can see it coming, so it's not like you just one day wake up and say, oh, now I got to move everything over. You slowly start to see the breakouts, the relative breakouts in the relationships, and then make changes accordingly to what you're looking to accomplish. Now, if we look at the international stocks, let's just kind of look at this chart for a second. So the green and red is the VEU, and it's down 14% from its high, where the S&P 500 just broke out from its January high. But it is in a slow grind lower. You can see, lower lows, right? Lower low, lower low, lower low, and then we'll just kind of see what happens here as this dollar is kind of pulling back into the zone. So I have them cross over each other just to keep an eye on them. I like to look at them on the same chart, but I mean, that's not good performance right there in international stocks. So eventually the tide will turn, but we don't know how long it will be. So the stronger is the U.S. stock. So that would, where I would, it's where I put my money. Looking at the VIX, let's look at this for a second. So I have a line drawn across the 20 level. The VIX has been very low and was very, very low back here, and then all of a sudden spiked as the market sold off in January, right? We all remember that, the waterfall, and look how quickly it can spike. So a lot of times what happens, and you want to pay attention. I don't know if I don't make trading decisions off the VIX, but sometimes when I notice the VIX initially all of a sudden spikes above 20, then goes back down, from my studies, sometimes it means that that's just the first crack and the market can come back, and the VIX can go down, and then it'll take another crack on the way down. But one thing I am noticing is kind of the trend, the trajectory. You can see this cup right here in the VIX, and you can see this going down, and negative VIX, when it starts to go down, that's bullish. That means there's less fear in the market. And then when it starts to turn the other way, at least what that means is more fear, more people are buying S&P 500 puts. So I'd be interested, I'm going to keep an eye on this and just kind of interested to see if it can continue to kind of grind its way higher. And if it gets up in the 18 to 20 range, then I really start to pay attention and say, okay, what's going on underneath the surface? My assumption is, when it gets up to here, that means breadth is probably really weakening. So again, it's not something where all of a sudden you're like, holy crap, I got to go make a change right now. It's pretty obvious to see when you know what you're looking for, but it clearly made a higher high right here. after a pullback, and now we're just kind of seeing if it can finish this cut. But that would mean more people are buying puts as the market's going on the way up. But again, let's just keep in mind that the S&P 500 is still above its 20-day moving average. The Nasdaq's on its trend line. All everything is really still bullish except for the last several days. So I'm not gonna just run out and say this is the big one or anything like that. But I like to pay attention when I'm starting to notice some distribution, what the VIX is doing, just to be aware, just kind of a more, you want to look at all the evidence in front of you to make your trading decisions. There's not just one indicator, there's not just one chart, you want to look at several of them. I'm in my industry ETF list, so let's just go through some individual industry ETFs. We'll see what's strong, what's weak. I'm looking at XES because it's what I do every day. No matter what list I'm looking at, I just say, what's the strongest of the day? What's the weakest of the day? Like, that's how I start. That's how I finish. So you can see defense, utilities, healthcare, REITs, all defensive plays, okay? But I did want to look at some oil ETFs a little bit. This looks not good. You have this is just him hawing along. Really, maybe this is a first stage base, but I don't know. It looks like it's ready to roll to the downside. It's clearly undercutting. Does it come down to here? I don't know, but oil stocks are definitely looking weak. The XOP looks a little better because it's not under the 200-day moving average, but still it bounced off the 200-day moving average right there and is failing. So I don't know if that's necessarily what I would call an area of opportunity. I'd definitely say that oil stocks are looking to be an area of weakness, where defense, aerospace, looks like a pretty neat chart. Now, this is a weekly chart breaking out to an all-time high. It doesn't really seem to be phased by anything. So looks interesting. The XLU looks more interesting, and the reason I say that is just because I think it's earlier in its move, and I try to find things that are earlier in its move rather than something that's just absolutely took off left to right. But still, it had, if we go to the daily chart here, you got a 3% dividend yield. It had a golden cross right here, so it was in bear market type activity, death cross, golden cross, pulled back, and now is breaking out of this cup with handle, which I don't necessarily know if I'd look at patterns, traditional patterns with ETFs, but it's definitely headed higher, right? When the Nasdaq's down 1%, this is up 0.8, so clearly money is flowing this way. Healthcare providers has no concerns. Look at that daily chart. It's hard to argue. This chart has just had no problems whatsoever. It's what I call the steady Freddy, where it'll just ride that 10-week all the way up. So, very bullish activity. And then you have medical devices, which I think are important. Just, nothing goes straight up. And man, that's a pretty good trend right there. It's found support at the 50-day moving average. It's way farther than the Nasdaq or the S&P 500 is above there. This was the January. This is when the market cracked right here. When everything cracked back in late January. The S&P 500 just crossed above this level. This crossed above the level in May. Made another high, another high, another high. Medical devices. The REITs are looking a lot like the utilities chart. You had the death cross and then the golden cross, and it's kind of grinding its way higher. But again, they're interesting because they've been out of favor for a while. So is it going to have, its time to shine? I don't really know. If we look at gold, looks ugly. Man, does that look ugly. It is just cracking. You can draw a trend line anywhere you want, and it is just falling. So that doesn't look good. And of course, I'm sure that has to do with the dollar and everything, but commodities with their death cross, and then oil's looking weak, is starting to crack. When that was the strongest and all the miners are already cracking, this is just one of those things where I get out of the way. There's no sense trying to fight the tape. Just get out of the way. At least that's just how I trade. Telecom continues to look really interesting to me for the simple fact that, man, it's been in a really bad bear market, and it did have a golden cross, probably right around the same time utilities and REITs did, but it was down quite a bit. I mean, this ETF, IYZ, has a 3% dividend. To me, that's not necessarily a reason to buy something, but I mean, it broke out of a downtrend. It had a golden cross. You know, telecom, if you're a conservative investor, it's looking like it's probably early in its move. Let's look at some financials, because I've noticed that they have, actually I want to go to, they're trying to hang in there, but they have not came close to clearing their January sell-off. They're still way behind, but they're close to breaking out. So we'll just kind of wait and see. I think they would have an inverse relationship with utilities, but if yields can go higher, I think that's going to be bearish for utilities, bullish for financials, bullish for banks. So if we look at the KRE, the banking ETF, not the exact same chart, but it's still, again, it has not, it really hasn't cleared. Actually, it has cleared, but it's in the last several months, it's weakened, but it could just be setting up kind of a not very exciting type of stock, but something worth looking at if it can head higher. Biotechs, looks like of all of the healthcare ETFs we just looked at, it looks like biotechs are the weakest, although I'm seeing some really bullish setups in some microcap biotechs. But again, you have biotechs is really interesting. Biotechs just really broke above, kind of grinding its way through a June 2015 high. I mean, they really got nailed after such a run. And let's just go to the monthly chart to really clear this. From 2008 to 2015, biotechs just were on a tear. And then for 3 years, did absolutely nothing. Now they're breaking out to new highs. So obviously you would say, well, you should have bought it down here. But I mean, if you look at it, if down here where you had another 3-year time frame where biotechs did nothing, then all of a sudden they started grinding through, then they went on a multi-year run. Could we be right here where we were right here? I don't know, but I don't think with the advancements in technology and medicine, I sure do like the industry long term. So that's really it. I really wanted to look at some individual charts. We can look at one. Actually, I do want to look at one tech chart real quick because I think I passed over it. We can just where was that? Just kind of IGV. This again has been a really bullish ETF, but it's also made a monster run. So you got to kind of think, when is it just a little smaller, deeper of a pullback going to happen? I don't know. But technology has been selling off the past several days, and it could have to do with, you know, the CEO of Twitter and CFO of Facebook are all getting grilled on Capitol Hill the last couple days about everything that's going on. And I'm not going to get into the politics side of things, but it could just be a sell-off in tech. But technology has definitely led the last couple years with QQQ and Amazon and everything. So one thing I continue to pay attention to is the relationship between international and U.S. stocks and that divergence, and are the global stocks going to bring the U.S. down, or is the U.S. stocks going to bring global stocks up? So it'll be interesting how it plays out, but at the end of the day, pay attention to what your individual portfolio is doing, because that's the most important thing. Don't always, sell on fundamentals or sell on the news, sell on the technicals. If the technicals start to break and it's time to get out, then you do what you got to do. So I hope this was helpful. Let me know if you have any questions.